The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Live Beginner's Course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Now, when we discuss PIP, it actually leads us effectively well into discussing the costs associated per PIP or the transactional costs for trading. That is known as the spread. But in terms of deliberating between a buy and sell interaction between the market, the spread is the difference between what is known as the bid, and that's the price that you could effectively buy the market at, and the ask, which is the price that you can sell the market at. So basically, there is a difference when quoting prices in the market, the bid and the ask. And there's a small premium, to be honest. We'll use oil as an example again. Let's say oil is at $61.50, quoted in financial markets. It will actually be quoted at $61.53 to buy that market, and to look to take a short position or sell that market, it will be quoted at $61.47. So there is potentially there a spread, of course, a variance between, or a premium between the bid and ask, and that's simply the small profit that the broker or the financial institution will make in offering these products to traders. A best bid is the best or lowest price a trader can buy the market at any given time, and the best offer is the price sellers offer the market down to for the asset at any given time. So they're selling this commodity or this foreign exchange currency. They're offering it to buyers. So we often refer to the ask as the offer as well. There is always a cost to trading the financial markets. So the spread there asks the trader to effectively pay a small premium between these two functions, the bid and ask, as a transactional cost to each particular trade. And that's something we'll physically see when trading these markets on the MT4 platform and towards the end of this particular webinar. The spread cost is action both when a trader enters and exits the trade, and that's often not understood completely in these markets. It is, of course, a cost or action when you decide to enter the trade and when you exit the trade. So do bear that in mind. The spread cost varies per market and asset class. Traders should be aware of what they are trading and the costs associated. So what does that tell us really? Well, it tells us that, of course, you're looking to, maybe cut down on your transactional costs for trading. Many markets, particularly the Forex markets, given their liquidity, are much cheaper to trade, i.e. their spread is much tighter and much more efficient, and that many assets, to choose one but a few, the more exotic currency pairs or commodities like cotton, have a larger spread. They are less liquid, or more illiquid, and are effectively more costly to trade. So that's going to impact, of course, your overall performance in trading, as well as the level of spread cost that you're performing in these markets. Illiquidity then will cause the spread to widen, while highly liquid markets will generally have very tight spreads. And I would just if I could discuss that in a little detail here. So we did discuss illiquidity there a few slides back, and we used the S&P as an example when news flow or an economic figure came to be released in the markets. What I described at that time was when both buyers and sellers effectively leave the market for a very short period of time, awaiting news flow to be released to the market. So because they're effectively leaving the market, there is, of course, less interaction between buyers and sellers. There is less price discovery between the closest median price, and that will cause the spread to widen. Effectively, the market will be at that time much more costly to trade. So what I'd like to do is just to deliberate between institutional trading and retail trading to give you an overall insight to what we look to trade between bid and ask here. And again, just to reiterate from all back there, lesson one, we do accept our role within this industry as retail traders. We're trading on our MT4 platform. We are at a competitive, I suppose, disadvantage in terms of looking to trade the markets. We do have a little less information, of course, but we obviously pay the premium then through this with the spread. So just when we look at the differences here, what I'll use is a little annotation to describe this. We have the S&P 500 here. This is an institutional trading platform. Here we have the ask, or what I mentioned, the offer. So these are sellers just looking to offer the next price to buyers who are looking to buy the market at potentially this price. Again, these are buyers who are looking to buy the market and placing orders at this price. Again, if you look to sell a market, you can effectively sell here at our 126055. So the market agrees a price where buyers and sellers meet. The price moves as the market trades. So you'll see fluctuations in this market. Potentially it looks stronger to the upside. The market could look to actually trade down, given a little bit of weakness there, or a little bit of what we would call offer strength. But effectively, there's no spread in this market. We can see if you want to buy the market, you can either choose to buy at this price, which is a market execution, or place an order to look to buy at our best bid price. Effectively, if you're looking to sell this market, we can actually place an order here at our best offer to look to hopefully get filled at our 126060. Or if we're looking to basically create a short execution, we'll basically just look to sell this market by taking one of these guys, or 124 orders that will effectively become 123, and we'll take a short position here at this price. So that just describes actual institutional trading and the market flow there. And what we can see is there's effectively no spread between the liquidity of this market. In total contrast to that, of course, we're using the MT4 platform. These financial institutions are quoting us two prices. One looking to buy the market, one looking to sell the market or take a short position, and then two prices here. So the difference between the bid and ask equals the spread. With this particular example, we have 2.5 pips. So a very liquid market at this time. It's a very short, tight spread. The CFD broker quotes these bid and ask prices in line with underlying markets. These prices move as the markets trade. So, of course, as the market trades, we will see an effective pip move to the upside and downside. But more frequently, if there's full liquidity in the market, the pip exposure will be the same, given there hopefully is no illiquidity entering this market. So you can see that we are effectively, because we're allowed and afforded these opportunities to trade at an institutional level, effectively with a retail trading platform, we are paying a little spread there for transactional costs. And I would like to note that just because there is no effective bid and ask spread in institutional trading, they of course pay their own transactional costs for entering the markets.